Alrighty, what's going on? Jason here, Live Financial Modeling. Um, some interesting developments related to the used car lot, used car dealership model I've been working on for the past couple days. So I was on Twitter. I randomly responded to, I didn't even realize it was a client I had a couple years ago, just as something. Um, and then he recognized me, called it out, and then he linked uh, this model, the car dealership model, to another Twitter account called Car Dealership Guy. And so that was interesting. We might do something, I don't know. But who knows? So before we get started, let me send out the live tweet. I wish I had this automated, but I tried. It used to be, now it's not. I don't know what happened. I tried. It used to be, now
Let's
it's not. I
copy
don't know what
this.
happened. Okay, and don't forget to subscribe, like the video. Most importantly, check out smarthelping.com. I've got, many different startup models for all different industries, SaaS stuff, real estate models, joint venture waterfalls, a lot of tools for tracking things for like HR, accounting stuff, some lending models. If you want to buy things in bulk, you can do so on the financial models tab at the top. You can get every template on the site for $9.99, or buy different bulks, or you can buy by category. So, you know, check it out. Okay, so the biggest, the coolest, I'd say the coolest upgrade we did was on this model is we reworked the way cars are purchased or vehicles are purchased and when they're sold. And then um so I had to do 10 matrix tabs to do this. And this changed from sales per month in each year to the amount of cars or vehicles purchased. And then this schedule defined when they're sold based on the month they're purchased. So you can have cars on the lot over time and it show the cash flow of that. It's very important for the first 12 to 24 months of cash flow planning. So this was really cool. Then I just reworked some of the layout of these assumptions. So you've got, average cost for up to 10 vehicle types, your markup, the resulting margin shows here. You could do the start month, adjust the start month that each vehicle you want to start selling starts at. Find the volumes purchased here. Also add this for extra revenue fee. I'm gonna add. Oh, I can't forget this. I need to add. I want to do also fee. Uh, so the fees as a percentage of sales price. This will be a cost to the dealer. So we're gonna add that. That's not that difficult to do. Um, yeah. So this is really great. You can see. And now, like here's a matrix tab. I did 10 of these, so you can see like all the logic that I had to do to make it dynamic with all those assumptions. And the main things we are going to use to get our balance sheet correct is, well, dollar sold is going to be revenue, but we have the amount purchased per month across, and you see we do this for all 10. So the amount purchased per month, the cost of goods sold per month, and this is going to reduce inventory. So we got inventory going up and down based on all these different assumptions, and then revenue. So those are the three main areas that I'm pulling from. Now, obviously, every single car dealership probably has their own little, unique caveats, but I'm trying to do something that's high level enough that will fit pretty much anybody. And we've got the percentages here for other fee revenue, other fees for an expense as like a catch-all. But really, we're trying to show cost to purchase inventory, when it sells, what's your margin. That's kind of how we're going to populate revenue. And then we've got all these different financial statements and schedules that are built around it to make it really nice. Fixed costs, we got a cap table, got a capex table, debt if you're trying to borrow some of your startup costs, terminal value. We're going to do some stuff here. This inventory tab, I might need it. I don't know. I'm gonna have to adjust it though, probably, but we're gonna keep it for now. Startup cost, and then today we're gonna be starting on the balance sheet and cash flow statement for this model. Let me check the stream. Okay. All right. So first things first today, we got cash flow monthly. And actually, oh, I hope the sound is working. Shoot. How do I tell? Let me go back here. Test. Test. Okay, good. So that's working. Uh, so cash flow statement, customer receipts. This is just revenue. So coming from the income statement, row 9, that's fine. Our first big thing. So payments for cost for goods sold. This is where we're going to do the cash reconciliation. So now I've aggregated this number so I can hit equals, and we've got this number here. This is the aggregate across all 10. So we can see total inventory purchased. So this is cash going out. Now keep in mind we've got cash coming in from the sales, cash going out, but this cash, so customer receipts is not looking at the cost of goods sold. Neither is OpEx, interest, or taxes, obviously. So this is where we get the actual amount of cash flow that's happening. And I still struggle to see. I get at a high level how the balance sheet is going to balance, but it's kind of interesting to think about how these formulas work and how your assets, cash, and um, equity, which is going to be basically be driven by retained earnings, how it all kind of balances out is pretty cool. It's really like a balance sheet is honestly like the most complex sanity checker. It's really just a sanity checker. And if it doesn't balance, then um, you've got something not working right on one of the either the income statement or cash flow statement or something else with your formulas. All right, so OpEx. Let me make sure this is good. So we're pulling 25 and 13. So we need to be pulling. Okay, so this is where we have to think. So we want to pull these costs. This is a non-cash cost, meaning the cash going out for these already happened, but this is when the cost is recognized when the related things are sold related to this cost of goods sold line item. So let's think about it. So it's going to be a negative number. We definitely have to take this number. If we add this in, we just have to subtract it out. So I believe it's not relevant to add in because it's a non-cash item and we're trying to reconcile cash here. Okay, so that's didn't change. That's fine. Interest is good and taxes. Okay. So we go capital expenditures look fine. Sale of business and fixed assets, these look fine. We're just allocating all to extraordinary income on the exit. So all that is here is for depreciable assets would be the building sale that's entered on this schedule. if we wanted to show some of the sales allocated here, and really, so the view that's being taken here is the view of the owner of this business, and the owner could be, you could have investors and or the owner, but it's trying to look at what actually cash is going to be generated from operations and exit after tax. Now, if you don't want to mess with taxes, you can always zero this out and then it will just not show up. But if you wanted to say include the terminal value, which you can switch on and off right here on the front, but if you wanted to include it, you can define how much of that's going to be applied to your fixed assets right here. And so now if we go back over the cash flow, you can see this is the building plus 569,000 of that. So you see the total here, 13.395 should be all of these totals. So you got extraordinary income, amount to capex. These are your two values from the sale of business plus your building cost or building value. Now I think I want to add ending car inventory balance. We're going to get to that later as an additional um, part of the terminal value because it's, I mean, if you've bought inventory and you've just got it sitting there, there's going to be some value to that. I believe, and I believe it's relevant to include, maybe we'll put a percentage thing so you can say of that total value, how much are you going to sell it for? It could be a discount or maybe a multiple or a positive multiple. We'll see. Okay, so these are all fine. Debt proceeds, principal payments, that looks good. Sale of company stock. So this number is the next big one. And this is what the model sort of solves for is I look at all the negative cash flows, including startup costs, any burn. That's going to include the purchase, the cash flow effect from purchasing inventory. And if it's delayed a bit, like let's say it's 0, 0, 0, and then like 25, 25, 25, 25, meaning that you buy it in month N and then N plus 1 month, 2, 3 months, you don't have any sales of what you bought, and then finally in month 4 through 7 you sell it all over that period. So if it's like that, we're going to have a pretty big cash requirement. And if we go over to the monthly detail, you can see this negative number growing as the inventory is purchased, but nothing's sold yet. All the way until here, it starts selling, but purchases are happening earlier. So that delay can be accounted for. Let me put in the other cash flow items from our cash flow statement into here, and then we can calculate the minimum cash, and that's going to go into the equity requirement. So taxes, this number. And I understand, I mean, you're not going to pay these taxes until the next year for whatever you did, but it's there's too much complexity in trying to get that right. So I'm just trying to say, okay, in this year you made X profit, what tax liability is that creating? And we're just counting that as cash. That's the only real kind of thing I'm doing that's not perfectly, really it should be a accrual, and a cash flow statement would have your tax payment coming out for this year in, in the next quarter, and it should probably be quarterly in the next year and so on. But the tax expense is realized. We're just saying it's realized in the month evenly across. If there was a profit for a given year, it's just going to go even for that year. If you want, and again, you can zero out the taxes and then it will just not show up, which is fine too. Oh yeah, okay, so cash flow, so we need to update these. So sale fixed assets, we'll get this in. Just this one. Sales business, this is extraordinary income. And then capex. I think we got everything else in there. widen this out a bit. The real value of the templates in my general overall design is just allowing some very refined timing assumptions and making it easy to change those. And that's honestly one of the hardest things that happens with modeling is timing. How can that different things change? And then we've got all these drivers for revenue. I mean, this is really, I really like how this new revenue assumption layout is working. Um, it's just purely better than what it was before. It really is awesome. It's really awesome. So where are we here? So this, and then we'll drag. So here, I already tried to put this in. Let's see. So what am I doing for 125? I need to be adding that because it's coming through as a negative. 26, 7 are plus. 8 and 9 should be also plus. And I will definitely know if I messed up a sign or something because something will not balance in the end between this and the other sheets. So, all right. So this looks fine. And you can see in year 5 here, the taxes are big because we're counting for this big sales proceed evenly split throughout the year. If you didn't want to show that, you can just zero these out, and that would immediately remove those big tax amounts, and you could just kind of do your own tax calculation if you wanted, or whatever. Or you could keep this in, but you can hit include terminal value no, and in that case, there's just a regular tax amount from operations, non-exit value, or exit value is not in there. So that's how those levers kind of work. I just put this as a 3x, and it's based on trailing 12-month EBITDA. Alrighty. Check this. So, looking good. We're looking good here. Now we can figure out our equity requirement. It's just going to be the min value of this row 133. So we can go here. 133. Now that, so it's saying we need 3.7 million. You can go over to your cap table. It's going to pop in here. You can define how you're raising that money and from who. How much, I did 3 stock types: common, preferred A, preferred B. You can do the total shares here, and for A and B, you're doing the total fully diluted share value based on these percentages. And then you could define the percentage of each share type that each investor is getting. And then overflow is just a catch-all. If there's any remaining between the top 19 outside investors and all the founders or owners' investments, if there's any variance there or difference, it'll just flow into here against this total equity needed. So if you see, if I put like 3790258, only this is now too much. We don't need any of this. And you're basically saying single owner purchase everything, and then you would adjust these percentages obviously to just 100%. Or if you had a joint venture and you had maybe half from the founder, half from another investor, and then maybe the rest came from somewhere else, and you define these percentages accordingly. You could get fully diluted shares, fully diluted ownership, applied valuation of each, and then I'll update this, but there'll be a distribution summary based on cash available to distribute for each individual. there's also going to be a separate high level. So this shows just basically the investor pool as one whole pool and the owner pool as another whole pool, and they just kind of cash flow analysis and net present value of those. And that will balance and match what's going on with on the cap table distributions. And there'll be checks to make sure that is true. All right, let's undo this. So we'll do another some here. Okay. And then your checks at the bottom here, these should all be zero to make sure you haven't allocated too many shares or gone over the amount of equity actually needed. If you want a reserve, you can always go into the startup costs here and put a reserve. And then technically, when you see the cash balance hit zero in a given month, which it will solve for zero based on how I just set this up, you technically would have this reserve amount still available, whatever that might be. Okay, so that's good. We got that in. This is all accounted for. This is. Now we're going to get into inventory stuff. Like, this balances right now, but I know it's not. Let's see. So, inventory, what's our calc here? We're doing cash flow, negative cash flow D10 monthly. So, okay, so you're taking out the, you're taking out, shoot, hold on. Maybe this should be the actual cost of goods sold. I don't know on my label here what I meant. Let's see. So this is the cost of goods sold that would reduce inventory. What am I doing here? So this, and then minus C14 here. Okay, so no, so that was right, I believe. So that's taking the total purchased, and we're doing a negative number because it's actually a negative, so it'll come through as a positive. So it's saying your inventory value equals the total amount of inventory you've purchased here minus the cost of goods sold in here, which makes perfect sense. So based on that, hold on, did we get a sign mixed up here? Negative. Let's see. Cash flow D10. So we're summing this. Okay. So this has got to be a negative value, which I didn't put that sign back in there because we're just summing up these. So if it's positive, it's positive, and then negative, it actually has to show the negative number here, which all these are out, and the first one's in. Let's update that. Now, if we go over to our balance sheet, so negative, really that's a positive, so 12,000. And then we're subtracting cost of goods sold. In this case, we haven't sold anything in the first month. So, and really until month 5, we don't see any sales. So watch this. So you can see inventory is going to grow. We do the previous month's inventory balance. What am I doing here? Plus, minus. Hold on. This should be minus a negative, so that's a positive, and then minus that. Okay, same. Ended up being the same thing. Good. And then so you can see the inventory growing because we haven't sold anything. And then here we're still buying stuff, so it's still going up, but also stuff is going down. So if we didn't include this sale here, the number is 385. Here it's 382. So we sold $3,000 worth of inventory, and that's just pulling this 3,000 right here for cost of goods sold. So you can see kind of how this works, and then it's going over, and this first of all, you can see this cash balance, see how it goes to 0 and 113, so that's good. That means we've got good logic here. Our inventory is growing over time, and then it should stagnate. Yeah. So here at 2873750, it now is we're basically selling everything that we're buying. So this is why I said the first 12 to 24 months, it's really important to have that logic because you get to see this how you stabilize. And then here inventory is just the same until now we change some things based on the purchase schedule. We're now buying more here, so it's going through the same logic. So you're going to get some different inventory balances. Um, and so at any one time, at the end of the month, this is the amount of inventory you have. Now this is the tricky part: is do we say, you know, this car inventory should be included in some of the cash available? And if so, how do we reconcile that? Do we just zero this out? Oh, shoot. Do we say if the terminal value is being included, then zero this last month out, and then that cash, that gets tricky though, because if it's a multiple, we might sell it for more than what it is. We could assume it's just always the same, because then you've got potentially like a gain. It gets tricky there. I think we just assume whatever the inventory balance is transferred as cash. Um, the same as cash basically in the terminal value. So we're going to actually add a line here. Um, value of vehicle inventory at sale. And we just do if this equals yes, then index, we just want to pull this value here. If we match the end month here against this, kind of 0. Otherwise, otherwise pulled 0. So there's that. We include this here. Now on the balance sheet, so see if we would have did a multiple lesser or more, we'd have to do some more stuff with taxes, gains, loss, all that stuff, and it's just I don't believe that granularity is super relevant for the purpose of this model. So we're just going to say it's just the value of that. Um, if we go to cash flow, sale depreciable assets, we're going to just add this into, well, we'll probably have to add a new row. It's not really an operation. I'm going to put under investing activities, sale of vehicle inventory at exit. So just go, if this equals our end month, pull terminal value here, otherwise 0. Okay, pull this down. And now that's yes, we got 3.3 million more. But for the assets to balance, we now need to say this goes to 0 if so it's greater than 0. Also do if this equals yes, then if this date equals the end month, then 0. Otherwise, do whatever else we were doing. Okay, great. That's good, 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 good. Now we should just see a zero value here on the end month. Perfect. And now that will update assets because the number is actually in this cash balance coming from the cash flow statement. So that's going down, but this is going up, so it balances out. So equity and all that still balances. It doesn't yet here. We'll see. Oh wait, 3327. Is that the equity? No, hold on. We'll see. That is the terminal value. So we'll have to see what we did there. Yeah, that's this value. So we zeroed it out here. It's included in the cash flow. Oh wait, it's not. Where is it? This is yes. So it should be here, November that. Oh shoot. Okay, so I zeroed it out, but I'm pulling that value from here. Oh dear, so that's a circular reference. That's the other thing with these is circular reference issues. So we definitely have we gotta think about this now. I'm trying to pull this inventory balance into cash. If I left it there, then this is gonna go up, but this is also gonna be higher, and we're gonna be double counting. So how do I figure out what the inventory balance is on this month if I'm zeroing that out on this month, you know? Because I could pull this. It is the same here, but it might not be depending on how the assumptions are and all that. Like this might not be the same number. I think we'll use this helper. So we'll just do this inventory calculation separately so I can pull from it without it affecting anything else. I think that's the only way. So inventory, I don't know if this is going to work. We'll see. It's just going to be negative the purchase amount minus cost of goods sold. All right, and then this plus this. Now in theory, so that's the actual calculation that's happening on the balance sheet. Now maybe I can reference this. And we could get, I mean, you could get more complex with this inventory. Like if you're buying inventory on payment terms, you don't actually have to pay for the inventory for like a month or two. You'd have accruals. It can get really complex, but I don't. We're not getting that far down into the hole here today. Alrighty. So what do I want now? So terminal value I actually want, if that's yes, I want to index. I'm gonna do this formula, but we're gonna go on that other tab we just built. Index here against this number or this date. Uh, Dang it. What? Match D3. Inventory 1, 2, comma 0. Come on, November 2026. Oh wait, were you off by a year? Or this needs to go for another year? I only went for 4. It looks like. Yep. Okay. So there's that. Terminal value is now here. If we hit no on this, it's zeros. Okay. Okay. That's good. Now let's see if we got a circular error. Okay, so good news. It looks like it did pop into here. This zeroed out, and now we balance on the end month. Perfect. Okay, so that wasn't too bad. So that balances. Let's put this end month back to the last month of the 5th year. Make sure it still works. It looks, yep, good. So this is equities in here. Okay. We'll see about this annual if it works with all the different timing assumptions. Oh wait, it's already not working. Let's see. 2709. So it's not pulling that in. Let's see, why not? Oh, because I didn't add it into the annual. So let's put this in. Pull it down. And there you have that. So now balance sheet annual does match. This is the right cash balance. Cool. Cool, cool, cool. So now keep in mind on this purchase schedule, you don't have to put 100% here if you think you're planning on some of your inventory not selling. Let's see. I don't think that'll cause an error. I think it'll just make your inventory balance a little bit higher. Let's see if we don't put it at 100%, what happens. Yeah, it just so that looks fine as far as the math goes here. So here you're at let's put a no on this. So here, oh, okay. Well, this is so false. If this equals yes, then do if global 0. Otherwise, okay, hold on. What are we stuck on? What logic? So if we're including terminal value, then do 0. So 0 it out. If we're not putting yes here, then this should be the value for no, which is another if, and if this equals that, the whole thing. We might be missing a parenthesis or something. If yes, okay, then do this. So we're missing, so if this equals yes, then do if that equals that, 0. We might have to switch the order of this. So let's pull this out and put this ahead of it. So no matter what, if we're greater than the end month is 0. Otherwise, if this equals yes, then do if that equals that. Oh, still same result. Okay, so let's see if this. Oh wait, no. Get that back to how it was. We need to pull out this one. I believe. So if it's greater than end month, which is global control C6, then 0. Otherwise, do if CA equals yes, if we include terminal value, then check if we are doing that, 0 out if it's the end month. Otherwise, that plus that. And are we missing an if? Yeah, here. So this is for if global control equals no, which you would then still do the same. You would still do this. Okay. Nope. Oh wait, is it no here? Okay, it is no, so that's right. What if we put yes? Okay, that looks good. 3494.50. 3498. That's our 3498 is our value there. And what I was trying to show you is what happens if this is 25%. Put no on this inventory. Or any inventory value is 3,327,000. So it's 3,327,000. If we don't sell, if we only sell 75% of the cars we buy here, then this inventory value should now be higher, 3,498,000, which is higher. So it was 3,327. Selling less of what you bought, it's 3,498. So about 200,000 or so. Okay, so that's good. We want that to make sense. Balance sheet's still looking good. I think we're looking pretty great here. We're looking pretty great. What else? Are we missing anything else on these three statement model logics? I think we're good. Now the monthly, we're going to have to add in this other thing. So sale of ending inventory. So let's put that in there based on the cash flow. Man, what a great model this is turning out to be. Holy cow. I'm excited. We're going to finish this today. All right. And now we do some, well, no, we got to do our distribution and executive summary. But this should match, this 20 million should match balance sheet cash flow against, so that 20, this, and then minus, because of monthly detail and annual details, not including this equity value here. Okay, so on this, let's add in here. Also, so it's 125 needs to be a plus. 8 should be a plus. There we go. So those are matched up. All right. Visual. Yeah, we don't need this one. EBITDA generated per car is kind of a cool one. I'm gonna do some. I like this chart and this one. We're gonna add some more, and yeah, we're gonna add some more visuals here once we finish. Okay, so executive summary. We want to pull our dates. We have two revenue. Oh shoot, I got to do that cost. So we're gonna do average dealership cost per car sold as a percentage of sales price. So you might not have anything here. You might, like, let's say you pay your salesman some percentage, or there's some cost that you need to account for. You can do that with this. And what we'll do, these should not be bold. Let's just put some values in here. And then so you can see, yeah, I'm going to also bring some high level data in so you can play with the assumptions here and see what your values look like. Okay, hold on. So I'm just going to duplicate this here. Okay, and this is average expense. So let's say, you get extra percent on the sale price and you pay 0.5 times. So that's just this number times sale price per car average. And let's say maybe this is 3%. So you see what the actual dollar value results there. And let's say this is like 2%. And so the way I'll do this is we can do monthly detail. Now I had other fee revenues here, which is just use the sum product of sales by type. Also do that sales by type times the other percentage to get fees. And we're going to put those into running costs here. And this is just going to equal this. In the calculation, we do sum product, all of the net sales per vehicle type against these percentages. And that's it. Drag it over. So that cost will scale with your sales. Let's put it into the annual. Also, I thought I changed this vehicle type. Alrighty. Let's add it here. And we can just go drag this down. And we're still balanced. Nice. Equals. I don't know why that didn't drag down. It's 26. Oh, I see. Alrighty. That'll work. 27.1. 20,715,000. Perfect. All right. So we added that. What else? Oh yeah, bring high level data. We'll do that at the very end. So we've got costs, cap table. Let's update this. We're good there and there. This is good. This was actually useful. This matches. Let's see about. Let's see about. Um, Executive summary. So we have car sales. We have other fee revenue. Car sales is just this. Other fee revenue. That. And our total revenue should match 43,371. Yep. Cost of goods sold. And then we really just have G&A here. And that's going to be this. Expenses, EBITDA 41,348. Oh wait, hold on. We're adding these expenses in with the cost of goods sold. So that is total revenue minus total expense. So 14,651 EBITDA. 14,651. Nice match. All right, now we've got all these different cash flow items here. We show it all in one spot. This is essentially the cash flow statement, but without the labels of the different, financing activity, operating, investing activity is just all shown right here. So sale fixed asset. We got a couple more items here. All right, is that everything? Taxes. Oh, and we're gonna need inventory purchases. And I should, in theory, just be able to sum up all of this. Plus EBITDA. Let's see, we're taking out, we probably need to add this back in. Okay, what are we at? 20,644,000. We're out by a bit here. Let's see, what are we out by? 70,000. 70,000. What could that be? Uh, so here we're taking out inventory, we're adding back in this, which should be fine. Let me set up the formula so I can see it. $70,515. Well, we know we're EBITDA matched, right? EBITDA was 14,651. Nope, 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 nope. Did not match. Well, if that didn't match, then these didn't match. So what's the income statement? 14,782. We're missing something on these. Let's go to, I guess, gross profit. It's 18,674. That matches. So as to these monthly costs. Oh, did I not add this into the income statement? OpEx, um, other fees, monthly 78. No, that's in there. So we're trying to figure out why we're off on the executive summary by 70,000. We know our gross profit looked good. This cost is 4,022,000. That's right. Cost goods sold 26,697. That's right. Oh, is this something with this? What's the total revenue here? 45,371. 45,371. Well, something's off. What the heck? My EBITDA's off. 14,651. Wait, no, that's the same. 14,651. And this is looks like it's out by 130. It's out by the startup costs, which is fine. Let's check this. So if we add this plus our equity amount and subtract that from balance sheet cash flow. Okay, so that's good. So the balance sheet matches the cash flow annual. We just had, did we change a sign of something? Let's see, sale fixed assets, capex, debt service, startup costs. All right, let's look at cash flow annual. This is equal to that. All right, and then we should match up this minus this. Oh wait, that's off. That's off. We're up by 11,000, 11, 12, 12. Well, what's that? What could that be? Interest. Interest. Okay. Okay, we're out by the interest. And I just put total debt service here. Cash flow D27. That's just principal payments. We want all of debt service. So, this. And now we're just out by the startup cost, which I mean, so these are definitely counted here. Are we not counting them? Oh, they're counted. Minus 123. Oh, what the heck. 2715. Let's see. So these should all be now 0 matches. And then this is going to be different because we've got incoming equity counted in the cash flow statement. Oh, it's 11:06. Looks like we are. Man, what is it? Wednesday? I might have to go into a Thursday on this, which is fine. But unless I go for another hour today, I don't know. All right, how are we off by this 130 is the main question here. That's definitely the number, and somehow I've double counted it somewhere. Let's look at our annual cash flow per period. Okay, so it's in our year one calc somehow. Um, where are we pulling this from? Income statement? Well, that'd be why, because that's including the startup cost already. So let's pull our G&A from this instead. And these are total. Okay, now we balance. So that's good. Okay, 2017, that matches the cash flow on the balance sheet. So we got everything accounted for. This does not count startup costs in EBITDA. The income statement does count it. So this is variance there, but it's fine. Um, okay. We can't do this until we do distributions. So distributions is going to be summing up our total cash per month and 133. If it's greater than 0. Then this will be doing the same thing if it's less than 0. Drag it over. Then we could say remaining equity is just going to be 133 plus equity. So it's actually saying we're borrowing more than the startup costs are. Let's make this negative. Let's do Only 100,000. In that case, we have right 133. Yeah. So we have 30,000 negative here, so we're going to use some of the equity on that. Cap table D3 is the total. This is just the total equity contributed. Here's usage of any remaining equity. It's all used up. And here's actual cash flow that can be distributed. So it's assuming all the money that's needed is up front, and then you distribute anything remaining. Okay, so this is fine. Cap table, perfect. All right, good. So this is 10. We're gonna have to adjust the cap table here. Oh wait, it's only 10. So is that right? 41.4, 66.6. Looks like it. Let's give this a decimal. Okay, 2,000,01945. 1945 to this all looks good. Okay. So that's updated. Well, I mean, we're really you know what? Let's just finish this. So on this, I'm going to pull in some data, some high-level data. Let's see. Min equity needed. We'll do revenue and EBITDA and cash flow. So this we can just reference over to the cap table. And now you can change your assumptions right here. Let's say these margins are lower, 50%. So we're lowering margins. That number's going to start to go up a little bit. So you can see how your equity requirement changes with this. We can also show different revenue for these years. So we'll show revenue, EBITDA, just operational EBITDA, and then cash flow. Get this in here. All right. So that's kind of cool. Let's see if we raise margins up. You can see the min equity is going to start to go down because you got less burn. We could do inventory purchases. Revenue kind of shows the sales. See if you lower this to like 5. You can then see when you start to actually lose money. Okay, that's nice. I'm gonna keep that here. I think those are the main items you're gonna be looking for in this one. All right, awesome. So nice visuals. This is offset. Let's change this. EBITDA per car. Oh, I don't have that here. Hold on. Let's put total cars sold. Where is this? I think that's a good metric to add. Purchased. So we can put it at the bottom here. Total cars sold. And we're going to pull from the matrix tab. Let me just check. So cars sold is here. So we want to pull 190 on each of these tabs. So let's go. Total cars sold. Vehicle type. And then here, what did I say? 190. Oh, so go find replace. We want to replace 376 with 190. And these are numbers. There we go. And we're going to do visualizations on all this stuff. I think that's what we'll do tomorrow is focus on some visuals, clean it up, do some sanity checks. Actually, I guess I could do sanity checks today, so tomorrow will just be visuals. Yeah, I'm feeling really good about this template. I can't wait to, I cannot wait to get it up and going. I mean, anyone doing a dealership is going to love this thing. All right, and then we'll add this to the annual as well. Make sure this matches. So you're selling 3,391 cars. Yep, perfect. Okay, and we'll bring that over to the purchases. And we could do EBITDA per car. So here, the amount of profit you're making per car. Obviously, if your margins are lower, this is going to go down. Whoop. Okay, visuals. Let's do this. Oh, we can actually do it monthly, but I mean, that's not. Let's change this. These are years. Average. Okay. Now, why is EBITDA per car going down? Well, let's think about that. Margins are all the same. It's the same percentages. Oh, well, it could be that our operating costs are going up for number one, and then stabilizing. And then once they stabilize, oh, they're going up each year. Well, that's why. It's basically because of this repair and maintenance. Now, this is actually repair and maintenance of like repairing your um, dry, the lot, car lot, maybe improvements on the building, not repair and maintenance of cars. So let's just stick this at like 10. And now you can see EBITDA per car is going up, which it should if assuming, because the only thing that's making that go down is your increase in OpEx. Okay, cash flow, cars sold per year, average EBITDA per car, and those will all be affected by all of these assumptions here. Just messing in here too. Yeah. Just making sure the numbers are doing what they should. All right, man, we are flying. I think I think that looks great. We can do a lot of visuals with all these different data points, like sales per car type, purchases. We can do stuff with, and actually, so we could have, and on this inventory, on the balance sheet, we could do inventory of each individual. We have the data to do it by each individual vehicle type, but I feel like that's just cumbersome. You can see the data here if you need. But I can do, charts to show what's purchased, what's sold over time, and all those different metrics by the different vehicle types. Vehicle sales. I want to replace anything that says car with vehicle. Wait, what? Replace all. Oh, it's because it's a text string, I guess. Vehicle. All right, so I'm going to end with doing the sanity checks. Make sure all our numbers are right. Index, I'll have to update this off stream, and then tomorrow we're going to do some visualizations on stream, and then this will be done. All right, so annual net income versus monthly, H59. Is that the right cell? Yes, 59. Balance sheet is in 60. Yep, 60. Okay. Annual detail check against monthly. That's this one. Annual detail check against cash flow. So this, what are we subtracting here? So that's saying index balance sheet. So the cash flow minus C60. Hold on. So any balance. Oh, so that is any balance. Okay. Or cash balance. That, and then we want to subtract from equity. Well, actually, subtract from this number and equity. So that should be 0. Executive summary to annual detail. Looking good. So that's I-34. Yep. Distributions to annual ending cash flow. So here, again, this is going to be that. So total distributions minus that, minus the equity. Okay, good. And then cap table. All right, so we're all good on our checks. Let me look at this, make sure this is right. Distribution. So this looks like it's fine. 2617. Yep. 2737. 2.7. Wait, hold on. Yeah, 2 million and 737. Okay. Aggregate IR is 20.1. Okay. Now, the big test is let's start changing some of this stuff and make sure we still balance. So let's go partial end year. Okay, we want to see all zeros right here. Let's go end of 1 year previous. Okay, let's go mid of that year. Okay, good. So that's all good. Now let's say include terminal value. Let's put no. Okay, good. And that mid last year and okay, good. You will not believe how much time and effort it took to make sure that the formulas are set up so these are um, always checked when the date changes on the end month. It is not easy. Okay, so we're good there. So this model is ready to go. I'll just update the index tab and I'm going to uh, add some visualizations tomorrow on stream. Other than that, we are all set. I'm pumped. It's a great model. It was already, I mean, before I had a lot of people buy this. Now with the updates, it's on another level. It's really good. Really good here. I think it's high enough level so somebody could just go in, plug in some numbers. Maybe they want to strategize. They might be a current used car lot or dealership, and they want to start getting into different car types or changing some things. They want to plan out what that looks like as far as purchases, revenues. They can play with all that stuff here. Let's put these margins back up to, or markup up to 100%. All right, I am headed out now. Don't forget, check out smarthelping.com for more templates like this. I'm putting, we're on like number 14 or 15. I will be updating all of the startup models I have with the same logic. I think I've got most of the SaaS ones updated. We're just moving down the line on this. Every week I'm trying to do one. So tomorrow we'll do visualizations. Friday maybe I'll do a completely new separate template for something else, like a one-pager financial calculator for some use. I don't know. we'll see how I'm feeling. But yep, this was great.